All right. So this both last month and this month we are releasing new future strategies and new option strategies all along the same type of theme. Um, it's a series that was adapted from when we traded Forex. Some of our best trading strategies have been Forex, and then we've taken those Forex strategies and adapted them to both options and futures, index futures and currency futures, because they work really, really, really well. And the one we're doing today is a strategy for market bottoms, how to find buying opportunities from after market has been declining. And it's a very early on buying strategy for to going long the indices. All right, so new index futures, swing trading strategies for capturing profits, and scroll down here a little bit. Just so you know, everything we're doing today is for educational purposes only. We're not giving any specific trading advice on any particular trade. Okay. What we're showing you is how myself and Becky, she's the co-host for this event and also my trading partner, how we go about making money from the markets. How we go, this is the way we've been doing it for a couple of decades now. This is our 21st year of trading. Our 21st anniversary is coming up in April. So just 2 months away. 21 years of trading. I was able to leave my full-time job in 2009 after starting in 2005, and I relied a lot on trading income to be able to do that. That was how I was able to walk away from engineering at Lockheed Martin, software engineer and hardware engineer. It was fun, but I have other things in life I wanted to do, and I can't do those things if I'm sitting in a cubicle 40 something hours a week. So now I have a lot more freedom to do different things. I don't have one thing. So instead of having one full-time job, I basically have 10 part-time jobs. Some pay, some don't, some do different things, but I'm able to do things I really enjoy doing. And whether it's training, kickboxing, Brazilian jiu-jitsu, I was just teaching a kickboxing class, very active in local government as a commissioner. I still do part-time acting and stunts. So everything, all these different parts of my reality, I'm able to do because I don't have to have a full-time job. I don't have to have a full-time job because trading provides that baseline of income. So that keeps me grounded. That keeps my bills paid, basically. So that lets me do everything else. All right, so scroll down a little bit more here. When it comes to futures, these are the only ones we trade. We used to trade a whole lot more, including a lot of commodities, lean hogs, live cattle, soybeans, the whole deal. But as time went on, we kind of settled in. As I started doing more coaching, it's not that we weren't good at and really enjoyed trading live cattle and soybeans and that type of stuff. It's just that that type of trading requires additional software purchases that cost thousands of dollars because we use specialized platforms for that. And the stuff we're showing to coaching clients, we want them to be able to use a broker's platform, which is free, and not have to spend thousands of dollars on a specialized software. So because of that, we have really just narrowed our own trading down to just these futures, which is the S&P to ES, NASDAQ the NQ, Russell 2000 RTY, Dow Jones YM, Australian dollar AD, British pound BP, Canadian dollar CD, Euro EC, and Swiss franc SF. So when you see those abbreviations, that's what we're referencing. Today, we're going to be focusing on the index futures and a strategy that one of the newest strategies, and I'm going to show you that grouping of new strategies and how the profitability adds to what we currently have. Okay. Again, check the chat window for the links to the handouts. Okay. So for the person who just said can't hear, um, is there anyone else having trouble hearing? Or is there something on your end, audio has to be turned up? So if you can't hear, maybe check your speakers. Sometimes I forget to turn my speakers on. Is the audio level turned down? Is it on mute? So check on your end because I think everything is going through on my end and other people can hear it. So check your speaker turned on and check your mute, check your volume levels. It might be turned off. This happened to me in the past. Okay, and let's scroll down a little bit more. This is the strategy, the general strategy we're going to be going over today. It's a long strategy for index futures. But before we start, what I want to do, I usually start out by taking a big picture look at the markets. So I'm actually going to change the share over to the charts for now, and then I'm going to take a look at the markets, and we'll come back to the handout and take a look at this particular strategy, which we're going to go over today. All right, so share, and I'm going to change over. Okay. So what you're looking at right now is the monthly chart of the S&P 500. Each candle is 1 month of time. Right here we are in 1997, 1998, year 2000. Okay, so we're going back 25, 26 years. The blue line is a 40 period moving average, simple moving average. This one exponential 40 period, this was exponential 40 period moving average. And you're going to see a 40 period moving average on quite a few of our charts. Started using it after we were learning from Oliver Velez, and he had a 40 period moving average on the chart. And we started putting that on our charts, and we use it in all different ways now. It might be a line in the sand, a trend indicator. So we use it in many different ways. You'll see a 40 period moving average on many of our charts, whether it's options, whatever it might be, futures. Okay, I'm getting a message here. You can hear. Yeah, Charles made a post here about hearing, so check that if that might be able to help you. All right, so this here is the 2001 market crash when tech fell apart. The bubble burst, all those dot-coms. This was the 2000 crash. This here is an 8 period moving average. Okay. So this 820 cross is a concept learned from a couple of different people. And basically, when the 8 is below, its market is generally bearish, or 8 is above is bullish. And you'll find that when the market gets below the 8, it will retrace back up to the 8, retrace back up to the 8, retrace back up to the 8, retrace back up to the 8. This is a monthly chart, but if you're also looking at a big picture on our daily time frames, when we get sell signals, if we get sell signals that just happen to occur after the market has gone down and then retrace back up to these levels, then you get a new sell signals on a daily chart. You have an extremely high probability of that short trade being that much better and going down lower. So you got to retrace up, and then up here somewhere along anywhere in this neighborhood, you get a new sell signal on the daily charts. The big picture is showing this is still pretty darn bearish, but you get a sell signal on the daily chart. Take your sell signal because a real good chance is going to push lower again. Retrace back up. You see any kind of sell signals on a daily chart or lower time frame, it pushes lower. Once we get back above the 8 period moving average, and now we are back above the 40, okay? What we tend to see is the market will ride the 40. It'll go above, pull back to the 40, to the 8. Go above, pull back to the 8. Go above, pull back to the 8. Go above, pull back to the 8. If you want the best possible trades on our daily chart strategies, which is what we focus on, daily charts, when we see the market pulling back anywhere in this area, and then we see new buy signals on a daily chart, those tend to be much stronger and better trades because there's a high probability it's going to continue that move. So every pullback, you'll be looking for charts to trades anywhere, long trades anywhere near the daily in this area on the daily charts. Rally, 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 pull back anywhere down here on the daily chart. Remember, this is a monthly chart. Each candle is 1 month. So if we pay attention to our bigger time frames, um, meaning, would you rather take a buy signal up here or down here? that type of thing. We might get buy signals up here and it'll pull back and go against you for a couple of months and take off. But when we trade some of these with usually with options in most cases, sometimes with shares, which I don't show at meetup, but we also trade shares. But we look for the pullback and then look for the new buy signal. Pull back on the big time frame, look for the optimal buy signals here. Okay, this was our 2008 crash. Okay. Once we get below the 8, retrace back up, and now we get a couple of consecutive closes below the 40. Usually tends to go lower, the markets. All right. And the same type of thing. It just dropped. Okay. This was the biggest market drop in US history. The market dropped basically 50% between 2008 and 2009. But we were still day trading back in those days, and those were fun days of day trading. Those were really actually fun. We were in the moment, we didn't know where the market was. We just see the buy signals and sell signals, buy signals, sell signals. One moment the market would be up 800 points, and then all of a sudden we see a sell signal and market suddenly down 800 points, up 800 or down 800, all within minutes. It was that volatile. Really fun, a lot of opportunities if you know what you're doing, and um, those were fun days of trading. But eventually, myself and Becky, we want to have a life. We can't be sitting in front of a computer all day long doing this stuff. So that's why we transitioned from being day traders along the way to swing traders, everything on daily charts. And we do some stuff on weekly charts also with options and shares. But here was the bottom of the market in 2009. And once we get back above the 40, what you find is every year or two or three, the market will pull back to the uptrending 40, major buying opportunity. If you're an investor, here's where you want to be a buyer. Okay. And for all the traders and more short-term investors, then every pullback to the 8, look for buying opportunity. Every pullback to the 8, look for buying up. Every pullback, every pullback, every pullback. This happens every couple of months. The pullback all the way to the uptrending 40 happens less frequently, but when it does, buying opportunity anywhere in this area, not an exact number. You have to anywhere in this area is the buying opportunity for long-term investors. And then it's back above. Okay. We keep going. This is COVID. This decline literally only really lasted 3 weeks, and then it was the biggest rally ever. Okay. Our single most profitable year of trading was COVID year 2020. I'll show you those numbers later on. All right. So, but the same idea, every pullback, buying opportunity. It closed below for the basic a week or two, and then it was took off. Every opportunity, every pullback, buying opportunity. A couple of years ago, this was in 2022, pullback. And when this happens, what you're going to hear on television, on news, and all those podcasts, people are going to be telling you the sky is falling. The market has dropped 10%. We're now in a bear market and it's going to go down forever and forever if we're in a recession. And they're going to tell you, they're going to make you think this is going from here to down here. This is just normal market movement, normal market pullbacks. Don't get caught up in the stuff they tell you on TV. They try to panic you because the folks on television live in the moment. If today the market just dropped 1,000 points, oh my goodness, it's good. If tomorrow the market goes up 1,000 points, they don't even talk about it anymore. They only talk about stuff that makes you afraid. Okay, so the market is going to go down 1,000 points. It's going to keep going down forever. We're going to be in a bear market. The same experts start talking. Well, there's a potential recession. Oh yeah, it's just filter out all that news and opinions. It's just news and opinions. That's why we do technical trading. And we just look for our trade signals. That's it. We don't. It's entertaining to listen to that stuff, but don't get caught up in it. Look at the charts. The charts tell you what you need to know. Pullback. This was not that long ago. This was in 2025. The market pulled back. I remember when I had a meetup going on, and this red candle was right down to about here. And I told the group during the meetup, look for this to drop about 10% more. The market drop about 10% more because we needed to get once we're below and it still looked like it was going lower, it's going to pull back to the uptrending 40. It was about 10% more, 15%, 10 to 15% lower. And then once again, buying opportunity anywhere in this area for the long-term investors. And if you're on a daily chart, you'll look for any buy signals on a daily chart because they're going to tend to be better trades. Okay. And here we are right now. This is as of Friday. Okay. Couple of weeks ago, the market pulled back, and people were like, "Oh my goodness, it was going to go down forever. It was some economic thing, some decision, oil or whatever it was, and they're going to go down forever." No, just pulled back to the uptrending eight, kept going. They're going to pull back again to the uptrending eight. Something eventually will trigger this pullback down to the 40. We need some kind of economic news, and now something is going to trigger it. And this is about a 15 to 20% pullback. And they're going to be screaming, we're in a recession. We're going to be everything's going all to heck, and bear market 10%. That's a catchphrase someone writes for the people to read the news. The people reading the news have no idea what that is. They're just reading some copy that someone wrote for them on the screen. Okay, so don't get caught up in this. We're in a bear market now. No, they'll stand the stuff they say. Um, know the charts. The charts will tell you what you need to know. And right now we're up here. We will eventually pull back to this level and then eventually to this level. And it'll be scary. It'll be a lot of noise. It'll happen quickly. This is normal market movement. Don't get caught up in it. Follow your trade signals. All right. So, with that, any questions? Feel free to unmute and ask any questions or type it in the chat window. Um, did you get your sound? Okay, should say.
Yes, I got it. Thank you.
Okay, cool. Thanks. All right. So,
Question. Can you hear me? Can you hear me?
yeah, I can hear you.
Oh, okay. Question. With
Yeah,
regards to long-term investing and like future swing trading futures,
yeah.
other than I guess I'm going to call it the psychology, is there mechanisms in future trading that lets you know that this is what it is? This is swing future, meaning you're not going to say, well, I'll just let it ride because you still have the mentality of a long-term investor. Is there something that you know that it's like, no, I can't do that here?
Okay, if you're going to be doing stuff long term, don't do futures unless you have a massively huge account because you have to factor in margin. And if it goes against you at 50 to 1 leverage, your account will be wiped out. So when I talk futures, it's usually short term daily charts. Shorter term, usually trades take hours to maybe a week or two in most cases. If you're looking for longer term trades like these, then now you're looking at options or buying shares. But we would not consider using futures for longer term plays uh, because the risk and the amount of capital needed to be able to survive through the swings is huge. Okay, so
Yes.
so when we do longer term for actual trading longer term, we will use the longer term charts, but it'll be with options or shares. I usually don't present shares during the meetups, but that I say for people on the side who have a bigger account and can buy the shares.
And I guess what I mean is, once again, you can have an investor account. Let's just put that to the side. I'm
Okay.
talking about getting your mentality away from just, I'll just let it ride. Is there kind of a default setting or a mechanism which is in future swing that you would know that, well, you can't let this ride because you got to get out of it?
That's what a stop loss is for. So
Okay,
everything we do has a first profit target.
gotcha.
So everything we do has a first profit target. After you have taken profit, you move your stop loss up, guaranteeing profit, and the remainder of the trade you can let ride. Let's say you have 5 contracts.
Mhm.
You whether it's futures, options, whatever it is, 5 contracts, or if you shares 500 shares, I might take 2/3 of the position off at the first profit target. So now I know I'm guaranteed profit. And then I
Okay.
move my stop loss up above break even, above where I got into the trade. So
Okay.
now I know I cannot take a loss on the remaining two-thirds of the two-fifths of the trades. If I have, let's say, I had five contracts, I sold three at the first target that's automatically executed on my behalf because I set the order and walked away executed. I now have guaranteed profit. Now I can have a secondary target that's really much bigger, much bigger. I always have a secondary target because sometimes the market makes some incredible, ridiculous move that cannot possibly happen, but does happen. And it happens. I've been in those trades where I'm like, what? And so I always have a much bigger target because if the market, you wake up one day, there was some anomaly in the market and the market shot up 3,000 points or something, it happens. Um, then you want to have a secondary target to capture profits, but your stop loss is in. If it goes the other way, you won't lose any money. You guarantee the profit because your stop loss is in. So yes, after your first target is hit, move your stop loss to protect profits on the remaining contracts or shares, and then have a secondary target way further away and let it ride. And as you get more and more profit, you move your stop loss up more and more to protect even more profits. So
Okay.
the let it ride mentality is great after the first profit target, and now you guaranteed a winning trade.
Okay. Thank you.
And yeah, so that's how we do. Now, the reality is, in most, probably only 30 something percent of trades, especially on the bigger time frame, make the big move. Most will retrace and stop you out. But those 30 something percent of trades, if you're very consistent, can be quite profitable. So if you're able to do that and be consistent with it, it will be a definite plus. I personally know people who started trading with me in 2015 as coaching clients, and they were trading the longer term strategies, not the daily chart options, but the longer term strategies. And they were buying shares because they had a bigger account. And it got to a point where the shares had gone up to a point where they just moved the stop loss up, okay? And they never sold those shares. To this date, they never sold those shares. And the market's more than doubled in value. So
Hmm.
they let it ride. They got in here and the first target is here. And so they put the stop loss somewhere above where they got in. They guarantee it can't take a loss. And it just
Hmm.
kept going up and up and up and up. And it's still been going up and up for the last 10 years. So they just kept those as long-term investments because they pay dividends. So, um, and so why even sell it if you don't need to?
Okay.
And plus now you have if you have shares, then you can also do covered calls and bring in even extra capital. I've had some people I've showed them more advanced ways to do covered calls on certain stocks, certain big name stocks, big dollar stocks, and but only at certain times of year. And if you only do it at certain times of year, there's a low risk of being called out and losing the
Okay.
stock. So, but yeah, you can capture some serious profits.
Okay.
All right, let's get back to the futures now. All right, so I'm going to switch to share. But anyway, that's the big picture look. We're way up there. And so don't stress over stuff you hear in the news. Markets just go up and down. And okay, I'm back on a handout now. So we're going to go through one of our newest strategies. Now, started releasing last month, the new strategies. They're all similar but different in the charts being used. So, but similar but different. Okay, so I'm going to switch, and then just so you know what's in the handout, like an example here, a second example, I'll go through the actual dollars made and dollars lost also to make sure you understand how money's made and lost. And I put here as an example of some of the index trades over the last 20 something years. This is not the full list. I just put some of the symbols that fit onto, so I can squeeze onto one page between the Dow, NASDAQ, and S&P. But this is the kind of win percentage is normal and expected. Um, it's right at upper 80 something percent wins on this for the indices. And the profit, and it's you're looking at making between $2 and $5 for every $1 lost. You've heard about making risking one to make three. That's never worked for me ever, ever, ever. I look to make 2 to 4 for every $1 lost. That's how we trade. We look to make between $2 and $4 for every $1 which we lose. And I'm going to ask you to go ahead and someone or some people take out a calculator because we're going to be using the calculator in a little bit to take a look at some of the trades. I'm going to give you some, I'm going to be asking for some numbers. So have a calculator ready to go. I'm going to switch to charts now and take a look at the charts and one of the strategies we trade. Okay. There's also in the handouts, volatility bands, double volatility bands. We use them in different ways, but we look for an extreme move lower. Okay. This yellow line on the chart, and these are squeeze indicators with different settings. Squeeze indicator is now pretty much on available for every trading platform. It was the one created by John Carter and Hubert Centers from Trade the Markets way back when. And that indicator is now become fairly standard on just about every analysis and brokers platform. That's because it works. Now we use different settings for different applications, and we use it in different ways than John and Hubert did. But you're going to see the squeeze on every single one of our charts because we use it whether it's to give us a directional bias or give us an actual trade signal. We use it in many different ways. Okay. So what we're looking for this, and you're going to find this true on many of our strategies and how we approach trading, especially with futures. For the short trades, we're looking usually for a close below some previous level. And for long trades, quite often we're looking for close above some previous level. And that previous level could be created by some form of indicator or some form of price level. We do everything with indicators because it's very repeatable, and 10 different people looking at the same chart will come to the same conclusion. I don't do anything that's subjective. If I do something where 10 different people looking at the same chart came up with 10 different outcomes, then that doesn't work for me. We don't do subjective stuff. It has to be repeatable, um, and liquid, very liquid. So here's what we're looking at right now. Um, the yellow line is part of a Donchian indicator. We use different settings, many different settings for different charts, but the same basic concept. So this is not standard settings, by the way. This is not default settings. For the coaching clients, I'll give you all these charts ready to go, set up, boom, go. If you want to try to create it on your own, you can, just trial and error. You have dates valid, so you can just sort of work with it and hit or miss and try to recreate it yourself. That's okay. But what we're looking for is an extreme move lower, touching the lower volatility bands, and a close above this previous peak of this Donchian line, which is right here. All this chop here is sideways. We don't deal with it. We want something that makes an extreme move lower and is now reversing. There is another strategy we have where this would be a buy signal. Okay. We're not talking about that. There's also another strategy where this would be a buy signal. Different strategy also. So, but for this particular one, we're calling it the super trend swing buy. The swing is what we're looking at is this swing upward and then down. And the top of this line swings upward and then down. The top of the move is what we're looking at to get a close above the top of this swing high. We're looking at the indicator. We're not looking at price. We're looking at the indicator. The top of this swings upward, then it swings downward. And then, so what I'm looking at here, after it touches the lower bands, what's the first close above this swing high? That's right there. That is the candle being considered to be traded. This would where we're looking at our trade signals. About 88% wins when we follow the rules. And we'll put numbers in there in a little bit. If I scroll back a little bit, touches the lower volatility bands. Here's that previous peak. Here is the date we'd be considering trading this day. So if you're here, you look at, hey, did it close above that date, that high today? Nope, that's the previous peak. 1 day later, did it close above? Nope, nope. It takes that long to review. Did it close above the previous? Nope. Did it close above the previous inverted V, that peak? Nope. You close, it looks like it's closed. Nope, it didn't close above it. Boom. Hey, it closed above. We have a trade signal. You look at your trading plan, all detail, 88% wins. You take the trade. And then we go through that in a little bit. This happens all the time. Touches the lower bands. Here is that previous peak, closed above right there. This is what you consider trading and evaluate it. And we have criteria to make it valid or invalid. Not every, just because that's there doesn't mean that's going to be meet all the criteria, but that is the candle being considered to be traded if it meets all the criteria in our trading plan. Touches the lower bands, there's that previous peak. That's the candle we consider trading under to be evaluated. Touches the lower band. Here is the previous peak, but before it got up to this level, it formed a new peak and it closed above this date. This is what we're calling swing two. Would be a new potential trade. And we have stats for that. It's not as good as swing one. This swing one, swing two. When price went back up, it didn't get up to this peak, which is what we really want. That's the really high probability one. But it formed a secondary peak and then closed above it right here. That's swing two, and we'll have stats for that. So some people are okay trading slightly lower probability trades, and that's up to you. It's still profitable, but lower stat numbers. So you have choices.
Hey,
Yeah,
we take
Ivan.
so you could take both of those trades. You're saying
Well, this one didn't
theoretically.
get triggered, but this one you'll have stats for it. So you look at the stats, you might see it's only 80% rather than 88%. If you're okay with 80%, great. It's still profitable as long as you're consistent.
But didn't it trigger a
So,
few days later, going up?
so here would be the day it closed above, and then we'd be buying, place your order and it gets filled the very next day when
No,
it goes
I'm
above the high.
the previous peak.
This
Yes,
this
that peak.
one becomes invalidated after this one gets formed.
Okay,
So if this secondary peak gets formed before this one is reached, this one is now dead. So this one can be traded if you choose to. And if it goes back down to the lower bands again, everything starts over.
okay.
Like here, um, touch the lower bands. Here, the date we consider trading. That'd be a good trade. Here, it touched the bands. Before closing above this level, it formed a new peak, and this would be that swing two. So the swing two is not shown on the handout. So there's a lot more trades besides what is on the handout, but we wanted to give you an idea of how we do this. It's coming off the bottom. And it may not be obvious, but for those of you currently trading our currency futures strategies, doing this is the equivalent of our 821 squeeze buy. The squeeze play buy is equivalent of a squeeze play buy or the Donchian stochastics buy. It's the same concept. Market goes up, pulls back, and then takes off again. Is the equivalent of those two currency trade strategies. The same, it looks different, but the same concept. So we trade the same concept in different ways. Always looking to close above a certain level which has previously been established. Okay. And that happens over and over again. Market goes down. Here's that previous level right here. Closed above. We would be evaluating this level or this day for evaluation. So here it is again. Market goes down. Here's the previous peak, and this is our signal day, the day it closed above this level. And it is that simple to identify the opportunity. It's very visual. The rest is trade management. And it works. This is, like I said, it's just one strategy out of a grouping, but of the grouping of strategies, they're all similar but different. It's very visual. Um, so I know some people always have hard time visualizing profitability. So how do we make money off this? So I want to I've reviewed it on the previous meetups for futures. So take a look at the meetup I linked in the chat window. I'll do it again, there again. But the futures meetup will go through a full review of all the numbers from previous years. I'll do a quick review right now. But if you want to do the full review, take a look at that, and that goes through all the numbers. But I want to show you how the new stuff kind of ties in and adds to the old stuff. So I'm going to change the share. This is just for profitability. Then we'll go through some actual numbers. All right. All right. So this is what I usually show you, and I'll take you back a little bit to the new stuff. So I got two spreadsheets with all the new trades, and this is all the old ones. So the new strategies basically add on to what you would have seen here. But I want you to understand how money is made and lost and some of the mindset. Because, okay, so I'd ask Becky we have this data going back to the year 2003. Okay, everything we see here goes back to 2003 in much detail. But I've asked her to put together all the numbers for the trades going back to 2019 to give you an idea how money is made, where we have an established account size, we're saying $25,000 account, and we're risking absolutely max 4% of the account. Normally you risk maybe 2%, no more than 4% of the account. You start going more than 4%, you risk over leveraging because of margin and other things and all the other trades you have to place. You don't want to run out of capital. So I'm risking $1,000. It may not be exactly 1,000, whatever. It could be less, it could be more. This can be $100,000 account, it could be $1 million account. It doesn't matter, it's all the same. Your percentage return in the first target is going to be anywhere from 25 or 30% to 50% return. That means $250 to $500 return at the first target. And for the person who asked the question after that, if you want to make more, you just you take part of the position off of the first target and trail the stops on the remaining contracts to try to make more. So I want to give you an example of what would be like a worst case scenario that just messes with your head. Let's say you signed up with me in January 2019 as a coaching client, and this is how you started trading. Keeping in mind these trades can last hours to a couple of days, and you're risking $1,000 a trade, 4% of the account, and you did nothing but lose money, first two losses, and then you made a few dollars back at the first target because you were in trailing stop, just taking first target profits only, all in, all out. And then your month is over and you're at a nice negative. And you'll be like, what did I just sign up for? And most people stop trading. They literally will stop trading because they'll say, the program I signed up for doesn't work. This strategy doesn't work. Nothing works. I'm just losing money. And that's where you have to be in communications with me because I always come back to these examples. No matter what strategy you're trading, you're going to have 2 to 3 losing months every single year. You will have, from those 2 to 3 months of losses, it will be negated by 2 to 3 months of winning trades. So that's the other remaining 6 to 8 months of trades will be your profits for the year. Okay. You can't make money if you stop after a few losses because you have to have the wins. You have to trust the process, trust the system. So let's take a look at this. After a month of trading, let's say you started this month and and it was awful. And this happens regularly. You get a couple of losses but consistency, and these are all futures trades, currency futures and index futures trades. And you're down 8.5% limited risk. Now, we keep our risk fixed. If you're going to risk 2% of the account, then you always risk around 2% per trade, and you trade size the appropriate number of contracts, whatever's needed to keep your risk around the same per trade. But this is awful. I just keep trading. The next month, 4.9 plus. Next month, you're well positive for the year so far after a couple of months because you don't need a lot of trades to have a really great return on account. You need quality trades and consistency, not quantity. It's not about quantity of trades, it's quality and consistency. As long as you follow certain rules, that's what I like about futures. We can actually predict how much we're going to make and lose as long as we maintain a certain percentage. Um, on our risk. A couple months go by, great month, 17% return in 1 month, 15% return, 5%. You don't dictate how to the market how much, you just place the trades. After 1 year, it's a 72% return on the account, risking 4% of the account per trade, which was $1,000. If you were risking, let's say you had a smaller account and you were risking $500 per trade, 2% of the account, then it's still a 72%. You're still going to get a high percentage return, but this dollar amount changes. Instead of $18,000 made, it'd be $9,000 made. That's about it. And instead of 72, it'd be 36% return. So I show all these numbers with a 4% account risk per trade, which is absolute top end max. But still realistic. This 25 grand account can be a 50 grand account. It can be a $15,000 account. It can be 100 grand. It can be 500 grand. The percent return stays the same. 2020 was our best trading year ever, COVID year. The same stuff, just consistency with trades. Consistency with trades. This is the first 1 or 2 months is when we had the big market crash. That doesn't impact us negatively at all. We're not negatively impacted by any specific economics things. When the year is over, the account size doubled. 103% return. Okay, so I'll only give you one more year and then just give you a feel for this. I would look for the bad months. Okay, this was 2022. We had a bunch of losses and 2 consecutive months of losses. And it drains you mentally. That's the psychological part of trading. You got 2 straight months of trading, you're losing confidence in yourself and me and the methodology. And here's where I have to talk to you and say, hey, you know, number one, you had a previous month with a 26% return. You gave some back, you had 2 losing months, you have to keep trading. And then but when you start get losses in a row, you start second guessing. Keep trading, keep trading, keep trading. The next month, you're up 20%. You made all that money back in the previous 2 months and then some, just by being consistent. When the year is done, you're up 64% on the account by being consistent. It's not you have to ignore the losses. You can't think about the losses. We all focus on the losses, but we forget about all the many wins we're getting along the way. We forget about that. We truly do forget about this. Would be a 34% return, 40% return. This would be a 65% return. Okay. Just as the first target, this is minimal profitability. If you want more, you have to trail stop, but this is at the low end, worst case scenario. Okay. So now let's go back to 2019. It was a 72% return. This is the old strategies. Now including the new strategies with which we're releasing this month and last month. Those are the bull run, bear attack, and super trend buy. That grouping all uses the same charts with small variations. It's the same family, same concept, close above, completely above the yellow line, that type of thing. So here are the new trades. So this would be all the new trades introduced with the new strategies for 2019. For the bear attack 1, bear attack 2, bear attack squeeze, and bull run currency, and the super trend buy. So these are all a grouping. They're all similar concepts, similar charts. But these are the new trades that would be introduced, and it created a 23% return with these new trades. So this 23% return in 2019, to give you an example, would be added to this 72% return. So that's what the new trades are doing for us. In 2020, where we got 103% return, doubling in value. In 2020, the new strategies, they've added another 6.7% return. So it added more profitability. In 2021, well, that's just ridiculously high, but that's what consistency does. You always say, how can I double my money? You double your money by being consistent with your trading and having a set risk per trade. With the new strategies added in 2021, it added another 35%. Okay, you could trade the new strategies by themselves and have a really great year, or 35% return on account. It's not as many trades, but money adds up, especially when you have very few losses. Keep in mind this for any size account. Futures, realistically, if you're trading currencies only, and you're trading micro contracts, you can have maybe a $5,000 account to work with as you build up. If you want to trade the indices, you're looking at least having at least 15 to 20 something thousand to work with. Otherwise, just focus on the currencies. The currencies are great. Most of these trades are currency futures trades. That's where the real money is. And then the secondary is the indices, but the real money is in the currency futures. But this gives you an idea of in 2022, it added 36% to our existing trades. 2023 added 9%. 24 added 30%. That's 30% on to existing profits from the other strategies. And in 2025, added 10%, almost 11% on to existing profits from. So this is all the new trades laid out. So if we had taken these trades at that time, so what we did was have Becky go back and document how trades would have worked out. And when it comes to futures, we can be pretty darn sure because futures are more exact. So you put in our entry, target, and stop loss, and we can usually rely on the execution being fairly accurate and correct. And so these trades, and this is not day trading. So we place these trades usually sometime between 3 p.m. and 9 p.m. Pacific time. So if you're on the East Coast, perfect. That's between 6 p.m. Um, Eastern time and midnight, basically. Eastern time when you place the trade. And go to bed. Nothing to do. You put your entry, target, stop loss. Entry, target, stop loss. That's it. And I'll go back to the chart. Do you have any questions first, though? Any questions up to this point? So you got a feel for profitability and how that's done. Okay. But I want to make sure you know how money's made and how it adds up really, 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 really fast. But that's not something you always fully comprehend is how money adds up. But from a 15 grand account, excuse me, from 25,000 and 30,000 in profits from 1 year of consistent trading. Okay. There's another column here that says overall growth, but it's not needed. I just showed if you start it's just showing if you start every year with 25,000, what do you make? It's not cumulatingly adding every year, but if you start every year with 25,000, what do you make? Type of thing. It's 2024, 53% return on a 25 grand account of 13,000. It was a 50 grand account, this would be 26,000. If it was $100,000 account, this would be 50, whatever that is, 52,000, somewhere there. So this lets you have a feel for profitability and how that adds up really fast. And here are the new strategies and how they add on to existing profits. All right, I'm going to go back to the chart. I'm going to change the share. I'll be giving you a good feel for how we trade and how we actually make money doing this stuff. So, yeah, share. Now, someone pull out a calculator, might have you do a quickie number for me. This is a NASDAQ. Micro contracts is $2 a point, a tick. Full size contracts is $20 a tick, or excuse me, $20 a point. All right. Increments in quarters. So 4 quarters equals 1 point. 1 point is $20. Or if we're talking a micro, 1 point is 10% of that. So 1 point is $2, and each increment is 50 cents. All right, so I'll give you an example of how we make our money. We're gonna always buy with a buy stop, meaning we buy if only the market is going higher. So take a look at the data box off to the side here. The high is, and Becky, can you type this into the data box? Please type this into the data box. The high is 25936.5. The high is 25936.5. Becky, please type that in. High is 25936.5. So type that into the data box for me. The entry for the trade is 2 points above that. Entry equals 25938.5. 25938.5 is the entry price. Okay. Stop loss is 2 points under the low. The low is 25365.25. The low is 25365.25. Please type that in. Low 25365.25. Low 25365.25. Please type that in. The stop loss is 2 points below that. So the stop loss is 25363.25. 25363.25. Please type that in. Stop loss 25363.25. Okay. We have an entry price, stop loss. What's the difference between these two values now? We're going to determine how big our stop loss is. So that would be, what is the entry minus the stop loss? So the entry is 25938.5 minus 25363.25. How big is that? Please calculate that for me and type it in, Becky. 25938.5 minus 25363.25. That's how big the stop loss is. What's that amount? 575 points. Oh, we got it. Okay, cool. All right, so that tells me how big my stop loss is. So if you're going to trade the indices, it's a little bigger account size needed than the currencies. You can trade with a 4 or 5 grand account, and you can trade the currencies. Indices are a little bit more, and this is currently, so this is markets are moving. That's how big. So now this is a micro contract is $2 a point. A full size contract is $20 a point. So what is 575 times 2? 575 times 2, that's the dollar risk per contract. 575 times 2. Number of points times $2 per point. 575. So 1150, 1,150. If you want to place this trade, you have to be willing to risk $1,150 on each contract. Because if you got in up here and it just went against you and stopped you out, you would lose $1,150 on each micro contract. If it was a full-size contract, it would be $11,500 per contract. If you were trading a full-size contract and took a loss, you'd be losing $11,500 per contract. That's the benefit of micro contracts. We looking for big targets and big moves, and so let's take a look at now. We're going to make our first target 50% of this risk. So what is 50% of 575? The risk is 575 points. What's 50% of 575? Please type it in. 50% of 575 is what amount? How big is that for first target? And we give you all these stats. We give you stats for 40%, for 45%, 50%, 60% of the ATR target. So we give you all these different targets. The bigger the target, less likely it'll get there before being stopped out. A smaller target, most likely it'll get there, and everything in between. Okay, so 287.5 points. Okay, what's 287.5 added to the entry price? So our entry price, so 287.5 added to 25938.5. So take 25938.5, that's the entry price, and add the 287.5. What's that number? 2 points above the high is the entry price. So the entry price is 25938.5, and we're going to add to it 287.5. What's that? Okay, 26226. Okay, so when we place this trade, I think somewhere along the way you're okay, got it. Okay, so here's where we get our buy signal. Okay, on this day. We look over on this day, we did not close. We reduce evaluation this day. We see the previous peak from the previous swing high. We didn't close above that value, so we move on. Next day, nothing. Next day, nothing. Next day, hey, wait a second. It looks pretty close. Let me check that. Okay, I put my crosshairs there. Hey, it did close above. I checked my trading plan. Hey, this is the NASDAQ, and this is 88% wins whenever this trade setup becomes valid. Hey, and my account has enough capital that I can place this trade. I have 15 grand in my account that's good enough to place this trade. That's a little bit heavy on the leverage, but depending on what else you're trading, maybe. But if your account is good enough, well enough funded, you can place this trade no problem. What I'm going to do after 2 p.m. after 2 p.m. Pacific, when the market closes, we place an order that says buy stop 2 points above the high, which is 25938.5. Buy stop at 25938.5. Let's say one contract, or let's say two, whatever. Just buy stop so many contracts at that price. And then trigger a one cancels other bracket order. When that order is triggered, you will be in two contracts or one contract, whatever number you put in, and then a bracket order will be formed with a target and a stop loss. My first target will be a limit order for 26226, and the other side of the bracket will be a stop loss for 25363.25. You just put an order in and walk away. You put it a buy stop for the entry, triggers your target and stop loss. Done. Go live your life. Go to the gym. Go take care of your kids. Go to school. Go back to work. Whatever you do, there's nothing else for you to do. If the market never goes up, to fill you, after 2 days, you cancel the order. If it goes down and never fills you, nothing. You just cancel the order after 2 days. If it goes up and fills the order, then the next day, it it triggered sometime the next day. In the trade, it did not go high enough to hit the target 26226. It went close 118, it didn't hit it. The next day, high is 26349. The next day, hit your target. You got your 50% return on your money within 2 days. That's how we trade. And we do this and maintain that upper 80 something percent win rate, and the numbers just work themselves out. And we end up making $2 to $4 for every $1 which we lose, as long as you're consistent with your trading. So this is how we place every futures trade. Whether it's currencies or indices, we place every trade the exact same way, and just walk away. It's not very time consuming. I say 30 to 45 minutes a day. It's actually less, realistically. I send out an email every afternoon with what we found valid, and you can compare it to what you find valid, and place your trade sometime between 3 p.m. Pacific and maybe 9, 10 p.m. Pacific. Just place the trade and go live your life. And that's how we trade. And this just happens over and over and over again. There's actually a trade I'm putting on this afternoon that's long on the Russell 2000. So after this meeting this afternoon, I'll be putting that trade on. It was valid this weekend. That one is 80 something percent wins. So I'm going to place that trade this afternoon. But this is how we trade, is how we place every trade. Um, Same type of thing on, pull up the Dow, YM. Whatever it is, this is NinjaTrader, so it's also free to use. If I'm looking at a trade scenario, I see it touch the lower bands. There's my top of the peak. It closed above, right about there. See, the things I think it closed could have been here. Either well, one of these, I think it closed right here. Fill the next day. There's my peak. But here's a secondary peak. This peak happened before this got reached. So then this one closed above this peak. Here's the peak, new peak, that's lower than this one. This is swing, this is swing one. It then, before reaching swing one, swing two got formed and it closed above that. So that would be the trade being evaluated. There's the one in the handout also. There is this first peak, touch the lower bands, and that's the first close above right there. Boom. And that happens over and over again. Here is it touched before coming back up here. It formed a new swing and it closed above right here. That is the new trade, swing two. Okay, so now you have a idea of swing one, didn't get back up in time, and swing two. And this pattern here happens all the time. It'll come down, up, pull back, and go again. We use the indicators to give us a good visual. It's maybe some people can see like, whoa, little squiggly little things here. That's for I can't visualize that clearly. That's why I use the indicators that makes it really clear. This doesn't tell me anything clear. Just looking at price. I need this to help me. This yellow line is nice and clear to me. Here is it went down, it went up, down, up. This is clear to me. That's why we use the indicators, because it's clear and repeatable, not subjective. Well, should I use this one here or should I use this one here? It went up, down, up. So should I with this? Which no, that's why I use this, because I can actually back test this easily, and it's repeatable and it works so well. All right. So today I wanted to, for the coaching clients, I'll be releasing this one in more detail in the very near future as they come up. I know some people have already requested a pre-release copy, and if you traded it, we have already had 1 or 2 trades in the last couple of weeks. So, but all new coaching clients get every new strategy. Anything we put out new, you get it. Okay. For the first year, anything new, we update the stats every 3 months. And I send out the trades for 1 full year. I'll send out all the valid trades every afternoon for futures and every evening for options and ETFs. So what you're finding valid should be the same as what we're finding valid. I do all training one-on-one, all coaching one-on-one. I'll pull up, go back to the handout real fast. If you have any questions, just go ahead, unmute and ask, or type it in the chat window. I'll take a look at it.
I have a question
Yeah.
about, hi, this is Olga. I
Hey,
have a
Olga.
question about, I accidentally closed the data box. How do you bring that back?
Just right click on the background of the chart and say show data box.
Right click on the,
Anywhere in the background
uh,
of any chart, and then find show data box. Did you see it?
okay, let me see.
I'm gonna switch back to my chart. And you have NinjaTrader 5, I believe, if I'm correct.
Yes, I do.
All right, so can you see my
Yeah,
chart now?
right
Right.
now I put on another strategy that has the data box, but let me
So you should be able to see them. Oh, come
go
on.
to the one that I made that mistake.
Okay.
Okay.
So data box should show up on everything. It's not specific to one chart, but as long as you're in that workspace, just right click on the background of any chart and it says show data box. Just make sure you select that.
Eversley, while she's looking for that, you mentioned you're going to do a Russell. Are you doing it on the RUT?
Yes.
So you're going to do a long on the Russell when the market opens.
Yes.
Now,
I know some people will
Oh, okay, got it.
trade the micro with
Control D.
M with the
Control
MJ.
D. Hmm.
Yeah. So
and
yes.
so based on, and so, and you're going to put the long on no matter what the news is and no matter what the market opens up at. If it gaps down, gaps up, whatever, you're going to do the long on the rut on
So
the.
I take a look at that strategy in my trading plan, and I don't recall offhand if it's a buy the open or buy stop. Let's see. Becky, was that a Donchian futures buy, if I recall correctly? Was that Donchian futures? It's this one. So if I recall correctly, this offhand, I always have to. I have like 8,000 strategies that I've created over the last 20 years. So I have to go back and look at the trading plan for specifics. But it's most likely buy the open or lower. So it's gonna be open or lower, and my first target will be based on the average true range. So I have this one is buy the open, I believe, and then my target is based on ATR. So the ATR of this is 57.13. So my first target is a multiple of the ATR, and it's about 80 something percent wins. But this one I'll be doing this afternoon after the market opens, and it's one of our indices strategies long. Right now, all of our index strategies are long because that's where the money's made most consistent, most everything. For the currency futures, it's long and short. But for indices, the long side, we just and it's all about risk management once again. You got to have your stop loss in. As long as you control your losses, the wins take at 85% to 90% wins. As long as you control those 15% losses to a fixed amount, you have to make money. You just have to. As long as your target is big enough to average a 40 something percent return at the first target. That's average. And if you can limit your losses to 2 to 4% of the account, the other So you got 15% losses, and of your trades are losses, the other 85% of your wins are going to be wins. You just make money. But you have to be consistent. There is no one good month or one bad. It's over a period of 12 months. What's your profit and loss? Not a month. That's why you have to keep trading. If one month may not be a great month, keep trading. But yes, I'll be trading this after the open, this Russell.
And it's the RTY, is that so you know how like the futures on the ES is slash ES, the futures on
Yep.
the NASDAQ is slash something. What is the futures on the on the Russell?
I actually was going to show some of that. Let me pull that up. I actually had the chart open. I mean, not chart, the broker's platform open. So I'm going to, it might be slightly different with different brokers. But hang on a second. Okay, this is the Schwab platform. Here, the stock indices. Um, slash RTY is Russell. And M2K is the E-mini Russell, micro E-mini. So
Okay,
slash
thank you.
RTY is the full size.
Good luck on it.
So, but yeah, you just put your stop in, target in. It's going to be fun because a lot of stuff happened on Friday, didn't it? But nothing really is
That
going
was
to.
exactly my point, right? So like he came in and said, all right, he's going to do 15% tariffs, and the tariffs impact the Russell more significantly. They're smaller cap. And so, but your strategy of like buy it at the open or better, I mean, it could gap down, which means you're going to get a pretty good price.
No, there is no good or bad. Everything is based upon the entry price. So I can get down here and then it goes up and hit a target. If this open, if in at 3 p.m. this afternoon, this opened down here and just goes to here, my target's reached. If this,
Understood.
if,
Because if you're going to put in your thing at the market or open, and if the market gaps down, and that's your price, it gives you that
no,
price,
I won't be
right?
putting on a weekend.
Oh,
If you are smart, you
yeah.
wait for the market to open
Okay.
because the only time we get gaps is the weekend basically.
Yeah. Yeah. Yeah.
So on the weekend, you wait for the market to open to see where it opened.
Okay. So you're
So
going to put your order in the minute it opens.
yes.
Okay, got it.
So I'm not going to because the market can be up here, gap up, fill the gap, and then take off, in which case I'm being stopped out. But my stop is still my stop. Or it could gap
We
down
don't
here.
we don't see your chart that you're
Oh, okay.
showing.
Yeah. Okay. Got it. Yeah. It could be a big gap up or a big gap down. I'm going to back
And
to my.
so if it's a big gap up, you're buying it at a high price, yeah?
There is no high price. The entry is the entry. The target will be so many points above that entry.
Okay, got it.
So every strategy for the Russell, Dow, Nasdaq, and S&P, the history goes back 26 years. Okay. So we look at every trade that's ever happened over the last 25, 26 years, including gaps all in there too. Now, if it gaps up, your stop loss is still going to be just as big. The size of the stop loss doesn't change. The size of the target doesn't change because everything is based relative to the entry price. So your target, if it's long and it gaps up there, your entry is so many points above that open price, and your stop loss is so many points below that price. So it doesn't really change anything. It changes nothing. So if the market opened up here, you should be able to see the chart now, then my target is going to be above this and my stop loss will be below it, the same amount. If the market opened right here, the same way it closed at, my target's up here, my stop loss is right down here. If it opened way down here, my target's here, my stop loss is here. It's all relative to where the market opens. So, and the target and stop loss. So it doesn't really matter what the market does. I just need to know where it opens at. And then I can place my trade accordingly. but the percentage, win-loss percentage doesn't change at all. Changes nothing at all. That's why there are some technical strategies that fall apart in sideways market that fall apart over time. That's why I've literally spent, if I say 30,000 hours, that would be an underestimation on all this stuff. I still every week, almost every day, look how we can improve on stuff we're doing. That's why we have the new strategies. I took stuff we've been doing and now how can I improve on it and more profitability, get more out of it, as Becky would say, squeeze more juice out of it. And we even had a trade called the juice trade because we were able to squeeze more juice out of it. We've been trading something for a long time. But as I personally gain more knowledge, I go back and look at stuff we've done in the past with the new knowledge. How can I get more out of this trade? How can I get more? There's stuff that 20 years ago went over my head. Now I'm getting it. Now I'm incorporating that knowledge that was beyond me 15 years ago. Now I understand it. Now I can incorporate that new knowledge and take stuff I've been doing and get more juice out of it. So that's my personal evolution.
Eversley,
Yeah.
when you're talking about the opening of the market, are you talking about uh, the open today, or are you talking about the New York Open? Tom
The futures market
tomorrow.
opens at 3 p.m. this afternoon for futures markets.
Okay.
So this afternoon at 3 p.m. the futures will open and I'll be placing a Russell trade. And it'll either be a good trade or it'll be a loss, but I don't care as long as I'm consistent. The numbers work themselves out. It's been a pretty good year so far, though. Pretty good year, especially with the currencies. All right, so I'm gonna now switch back. We're gonna bring this to an end. We're gonna be meeting again in about 2 weeks, and that'll be on options for that particular one. Let's see. Yeah, in 2 weeks we're gonna meet on options, and we introduce one new option strategy this um last month based upon the new approach we're doing. But um, if you're interested in working with me, let me know by this Friday for any discounts. I do everything one-on-one. I don't believe in doing group trainings and that type of stuff. What I've learned is that everyone learns differently, and I might have to explain the same thing 3 different ways to one person for them to get it. Not everyone takes the same information and processes it the same way. So things I think are simple, certain people agree are simple. Certain things I think are simple, certain people just don't get it, and I might have to like, okay, let me find a different way to present this. So I want to make sure you get it. So one-on-one, if I can work with you in person, even better. If you're anywhere near Santa Clara, I can make it to Santa Clara, even better. I can meet with you in person at least once or twice. The software analysis platform, NinjaTrader or Thinkorswim, depending on which we're doing, futures or options. But either one is free trading platforms. I mean, free analysis platforms. But 250 off either trading or 750 off if you're doing both. The futures is 1745. The details are on my FAQs page on my website. This is summarized, but this is what we trade. And I give you a feel for this, how we do analysis, how we trade, and how we profit. The different strategies are all similar but different. Same concept, very visual. Find a setup, trigger, trade management. That's all terminology from Jake Bernstein that I've adapted over time. The setup is visually what you see. The trigger is some other little details to confirm it. But what we looked at mostly was the setup to see, here it is, that's the setup. And then it's easy to spot visually. And then the little detaily things to confirm it, that's the trigger. And the rest of the trade management, we kind of went through one particular trade example. That's trade management. Then we go through it in detail with you. And then make sure you understand position sizing and profitability, that what I showed with the point since 2019. We go through that in more detail so you really understand that risk management, because futures can be your best friend or your worst enemy. But if you treat it with respect, futures trading, swing trading, especially with the micro contracts, are the best because they're very exact. And a lot of people I work with are people who have been engineers, scientists, technical type people, accountants, insurance people. They know numbers, they like specifics. That's why I like futures, because everything is very specific. So it works really, really, really well for us. And although I say minimum 6 month guided support. I've never put the people who have contact who I started working with 15 years ago. I still call me. They want to meet. One person specifically I started with a long time ago still emails me almost every day for the last 17 years to confirm their trades are good. Um, and so however long it takes to get you going, I don't have a problem with that. Um, so usually within 6 months, you've pretty much got it down as long as you're consistent with your trading. I do ask you to commit 3 to 6 months to see the wins and losses and how they work out and balance out because you will have some wins and losses. You go through the ups and downs. I want you will experience all that. So I really need you to commit on your end to placing the trades, whether indices or currencies or options. And everything I do is one-on-one because it just works really well for us. And if you're doing both at 34.95 minus the 750, I take 750 off if you're doing both. If you want to do one now and do one later on, I'll still take the 750 off. Just remind me that you were doing both and I offered you to. So you can do one now and later on, I'll still take 750 off if you're doing both. Just let me know. But that's the deal for um, futures and options is 1750, same type of thing. And I'll take the 250 off. Well, let me know before this week is over so I can get you. I don't take on more than 1 or 2 coaching clients a month because since everything is one-on-one, I need to be able to have time for you. Okay. I do a lot of other things too, so I want to make sure I have enough time for everyone and we all meet at times that we're mutually agreeable, whether it's morning, afternoons, evenings. I don't do anything on Saturday. Saturday's my time, but Sunday afternoon, I'm usually meeting with coaching clients. So let me know and we can really get this going. I don't care if you're a newbie or you're experienced, this works. If you're more experienced, we get into it faster, start making profits faster. If you're a newbie, we'll hold your hands, get your account set up, get everything down and start trading small until you're comfortable, then you get bigger and bigger trades. And then it's once you see how this stuff works, it's really sweet. It really is. I love this stuff. Always have been 20 almost 21 years now. I still love it as much as I did 21 years ago. So I'm not gotten bored. I love this stuff. This is awesome. And doesn't matter what's going on in the world, doesn't matter what economic anything is happening. This is technical trading at its best, and futures work so well. All right, so unless you have any questions, we're going to call it a day, and we'll resume in 2 weeks from today, and that one will be on options. And as far as this, call me, email me, message me. All my information on the handout, also on my website. Um, Everything's there. So any details, any questions, if you want to go over realistic expectations, definitely call me and I'll go through realistic expectations with you and realistic time frames and what's needed. All right. Otherwise, I'll see you all in 2 weeks. You all have a good day. Time to watch closing ceremonies of the Olympics, which I have recorded.
Thank you.
Thank you.
Goodbye.
See you next time. Push the record button. Stop it now.